4 days ago, I was going through routine commodity data when something stopped me cold. A single number on the Shanghai Futures Exchange Vault report looked wrong. Not slightly off. Dramatically, impossibly wrong. So I did what any rational person would do. I assumed it was a data error. I refreshed the page. Same number. I cleared my cache, reopened the browser, went back to the source. Same number staring back at me. That is when I opened a spreadsheet and started pulling the historical data point by point. And what I uncovered over the next 72 hours has fundamentally changed how I understand what is happening in the silver market right now. If you have been watching silver prices crash and wondering whether you made a terrible mistake by holding physical metal or mining stocks, this video is going to answer that question. But not in the way you might expect, because the answer is not in the price. The answer is in the vaults. And the vaults are telling a story that directly contradicts everything the mainstream financial media is saying about silver. I am going to walk you through exactly what I found in the exact order I found it. By the end of this video, you are going to see a number that will make you pause and reconsider everything you thought you knew about this so-called silver crash. I know because that is exactly what happened to me at 2 in the morning 3 nights ago when the full picture finally came into focus. Let us start with the data. Welcome to Finance Currency, where we follow the money that the mainstream ignores. If this investigation reveals something the financial press missed, hit subscribe and turn on notifications. You're going to want to see what comes next. The Shanghai Futures Exchange, known as the SHFE, is one of the 3 largest silver trading platforms on Earth. And unlike many financial institutions that hide their data behind paywalls and delays, the SHFE publishes its vault inventory numbers publicly. This is not rumor. This is not speculation. This is not some anonymous source on the internet making claims. This is the exchange itself reporting exactly how many tons of physical silver bars are sitting in its warehouses. Real metal, real vaults, audited numbers, updated daily. I went to CEIC, which is one of the most respected economic data platforms in the world, and I pulled the complete time series for SHFE silver vault inventories. What I found made my stomach drop. In mid-December 2024, the SHFE reported approximately 900 tons of physical silver in its vaults. 900 tons. That was the baseline. That was the starting point. Then I looked at the number from 7 weeks later, 423 tons. I stared at it, then I did the math. Then I did it again because I was convinced I had made an error. I had not. 54% of China's primary exchange silver inventory had vanished in just 49 days. Let me say that again because I need you to feel the weight of what I am describing. More than half of the physical silver sitting in China's main futures exchange vaults walked out the door in less than 2 months. Not over a year. Not over a quarter. In 49 days. I started pulling the daily data to see if there were any upticks, any reversals, any days where metal flowed back in. I checked day after day. December 15th, lower. December 16th, lower. December 17th, lower still. I went through 6 straight weeks of data. Every single entry was smaller than the one before it. Not most days, not on average. Every single trading day without exception, the number went down. That is not market fluctuation. That is not seasonal adjustment. That is not normal trading activity. That is a one-way door. Silver is walking out of those vaults and not coming back. Now let me give you the context that makes this number truly alarming, because 900 tons dropping to 423 tons sounds abstract until you understand what it means in the real world. The weekly drain rate is 42.6 tons. That means every 7 days, another 42 tons of physical silver leaves the SHFE vaults and goes somewhere else, somewhere we cannot see. The daily drain is 10.78 tons. And here is the part that kept me up at night. When I overlaid the data on a chart, the angle of decline is getting steeper, not flatter. The drain is not slowing down, it is accelerating. Now put this in global context. Combine the SHFE vaults with the Shanghai Gold Exchange vaults, and you get roughly 900 tons total of exchange-accessible silver in all of China. That sounds like a lot. It is not. 900 tons equals approximately 29 million ounces. The world consumes over 1.2 billion ounces of silver every single year, which means all of China's exchange-accessible silver, every bar in every vault, covers exactly 2.4% of 1 year of global demand. 2.4%. That is not a strategic reserve. That is not a safety buffer. That is fumes. That is the gas light blinking red while everyone pretends the tank is full. And here is what no mainstream article about this data has done. None of them ran the math forward. So I did. If the drain rate holds at 42 tons per week, and current inventory is approximately 412 tons, according to the latest data, then you divide 412 by 42, and you get 9.8 weeks. Call it 10. In 10 weeks at the current trajectory, SHFE silver vaults hit zero. Not low, not concerning, zero. Empty shelves. Nothing left to deliver against futures contracts. Now I need to stop here and address something directly. If you were sitting on physical silver or silver mining stocks right now, and you just watched what looked like a devastating price crash, you need to understand what this number actually means for you. The exchange that backstops a huge portion of Asian silver price discovery is running out of metal. The vaults are draining, the clock is ticking, and nobody on mainstream financial television is even running this calculation. That silence tells you something, and what I found next made that silence even more suspicious. After discovering the SHFE drain, my first instinct was to explain it away. Maybe this is just a China story. Maybe Chinese industry is pulling metal for solar panels, electronics, and manufacturing. China is the world's largest consumer of industrial silver. Maybe this is domestic demand and has nothing to do with the broader market. Case closed, move on, nothing to see here. That is what I wanted to believe. Then I pulled the COMEX data. COMEX is the primary silver futures exchange in the United States. It is operated by the CME Group, and it is where the vast majority of paper silver gets traded globally. It is also where, theoretically, traders can stand for physical delivery and demand actual metal instead of cash settlement. The COMEX vault data is supposed to represent the physical backing behind one of the world's largest derivatives markets. According to data reported by the COBC letter and confirmed across multiple financial sources, COMEX silver inventory dropped to 415 million ounces in late January. That is the lowest level since March of the previous year. A 34 million ounce drawdown from its recent peak. But here is what stopped me cold. According to detailed analysis published by SHFE Gold, the registered silver on COMEX, and registered means the metal that is actually earmarked and available for delivery against active futures contracts, has been experiencing major sustained outflows since September. Now there is a technical distinction here that most people miss, and it matters enormously. COMEX vault silver falls into two categories. Registered silver is metal that is tagged and ready for delivery. If you hold a futures contract and you stand for delivery, registered silver is what you get. Eligible silver is metal that is stored in COMEX-approved warehouses, but has not been designated for delivery. It is there, but it is not committed. What the data shows is that eligible metal is being converted to registered just to satisfy the demand from traders standing for delivery. The exchange is not bringing in fresh silver from outside. No new metal is arriving. They are simply reclassifying what they already have and moving it from one column to another. I want you to understand what this actually means. Imagine a restaurant that is running out of food. Instead of restocking the kitchen, the manager starts renaming the appetizers as entrees. On paper, the menu looks full, but walk into that kitchen and the shelves are empty. That is what is happening on COMEX right now. The menu looks complete, but the kitchen is running out. So it is not just China. COMEX is draining too. Two of the three largest visible silver inventories on the planet are losing metal at the same time, in the same direction. At that point in my research, I genuinely did not want to check the third major inventory, because I already suspected what I would find. But I had to know. I pulled the London Bullion Market Association data. The LBMA operates the largest physical precious metals market on Earth. This is where central banks, sovereign wealth funds, and major institutions trade physical gold and silver in quantities that make retail markets look like pocket change. According to analysis published by AU Bullion Canada and multiple independent precious metals researchers, the LBMA's estimated free float, which is the silver that is actually available to settle London's massive unallocated accounts, has collapsed to what one source described as the lowest level in modern history. Let me be precise about what free float means. In the London market, most silver is held in unallocated accounts. That means you have a claim on silver, but you do not have specific bars assigned to you. The free float is the actual metal available to satisfy those claims if holders start demanding physical delivery. And that free float has been shrinking for years, accelerating over the past 18 months. According to a detailed report published on Trading Key, for the first time in modern market history, all three major transparent silver inventories, Shanghai, COMEX, and London, are draining simultaneously and at record speed. The report estimates that nearly 1 billion ounces of refined silver have vanished from visible stocks since 2021. 1 billion ounces. Now I need you to hold these three facts together in your mind at the same time. Shanghai draining, COMEX draining, London draining. Same direction, same time, same metal. There is no historical precedent for this. This has never happened before in the modern silver market. 3 continents, 3 exchanges, 3 vault systems, all losing metal simultaneously while the price on your screen crashes lower. If this were happening to oil, it would be the lead story on every financial network in the world. Analysts would be on television 24 hours a day explaining the supply crisis. If this were happening to copper, congressional hearings would be scheduled by Friday. Senators would be demanding answers. Emergency meetings would be convened. But it is silver, so you are hearing about it from finance currency instead of the front page of the Wall Street Journal. And honestly, that silence is part of the story too. Because silver does not evaporate, it does not dissolve, it does not disappear into thin air. When silver leaves an exchange vault, it goes somewhere. Someone signed a delivery warrant, someone arranged armored transport, someone took possession of those bars, and whoever it is, they are doing it simultaneously across 3 continents at a pace that has never been seen before. Which brings me to the question that kept me digging until 3 a.m. for 3 consecutive nights. Who is taking the metal? And why are they taking it now, at this exact moment, while the price is crashing? The answer I found changed my entire understanding of what is actually happening in this market. And it is not what the mainstream narrative wants you to believe. When you see vaults draining across 3 continents simultaneously, the first question any investigator asks is simple. Who is taking the metal? Because silver does not move itself. Every bar that leaves an exchange vault requires paperwork, logistics, and a buyer on the other end. Someone is systematically acquiring physical silver at a scale we have not seen in decades. I wanted to know who. Let me start with what I found on the COMEX side. And I want to be absolutely clear about what is confirmed data versus what is my interpretation connecting the dots. On January 7, 2026, a single day of COMEX deliveries moved 8.1 million ounces of physical silver, 8.1 million ounces in 24 hours. According to detailed analysis published by Jesse Colombo on Substack, JP Morgan delivered 99% of that total. One bank, 8 million ounces, one day. Now, in any normal delivery month, you would expect that kind of massive settlement to cool demand. Contracts are fulfilled, buyers are satisfied, open interest should decline, people got their metal, transaction complete. That is how delivery months are supposed to work. But that is not what happened. After that massive 8.1 million ounce delivery, open interest went up, not down, up. New buyers were piling into the market as fast as the old ones were getting filled. And according to analysis from Money Metals Exchange, something even stranger was happening behind the scenes. Traders were rolling contracts backward. They were taking March delivery positions and pulling them into January and February. In normal markets, when people want to delay taking delivery, they roll forward. They push their contracts into future months. Here, they were paying a premium to accelerate. They wanted metal sooner, not later. There is only one logical explanation for that behavior. They do not trust the metal will be there if they wait. These are sophisticated traders who can read the same vault data I am showing you. They see the inventory numbers collapsing. They see the drain rates accelerating, and they are racing to get their metal out before the shelves are empty. One analyst quoted by Money Metals put it bluntly, quote, "If this is what is happening, COMEX could end up in big trouble," end quote. Now let me take you back to China, because while the vaults were draining, something else was happening on the policy side that completely changed my interpretation of this entire story. This is the part where I went from thinking this is interesting to thinking this is deliberate. On January 1st, 2026, China's Ministry of Commerce implemented new export controls on silver. I went to the original MOFCOM announcement and cross-referenced it with CNBC's reporting to make sure I had the details correct. According to CNBC, the state-run Securities Times quoted an unnamed industry insider who said the new policy, quote, "formally elevates silver from an ordinary commodity to a strategic material," end quote. I need you to let that phrase register. Strategic material, that is the same regulatory category China uses for rare earth elements. The same category China used to bring Western technology supply chains to their knees over magnets, semiconductors, and advanced electronics. Silver now sits in that same bucket. Under the new rules, only 44 large state-approved companies are permitted to export silver. These companies must produce at least 80 tons of silver annually and maintain $30 million in credit lines. According to FX Street's analysis, these restrictions effectively lock 60 to 70% of the world's refined silver supply inside Chinese borders. Hundreds of small and mid-sized silver exporters who had been supplying metal to global industrial users for decades were locked out overnight. One day, they could ship silver to Tesla's battery facilities, to solar panel manufacturers in Europe, to electronics companies in Japan. The next day, that door was welded shut. Tesla CEO Elon Musk responded on his platform X by writing, quote, "This is not good. Silver is needed in many industrial processes," end quote. And here's how you know these restrictions are real and biting immediately. According to CNBC, within days of the January 1st announcement, 2 Chinese companies contacted Canada-based Kuya Silver, offering to buy physical silver at $8 per ounce above market price. An Indian buyer followed the next day, offering $10 above market. When buyers start calling miners in foreign countries and offering massive premiums just to secure metal, you know the restriction is not symbolic, it is choking supply in real time. China did not ban silver exports outright. That would have been too obvious. It would have triggered immediate international response. Instead, they did something more sophisticated. They created a licensing bottleneck so narrow that most of the world's silver refining capacity is now functionally landlocked inside Chinese borders. Now follow this timeline with me, because this is where my investigation changed direction completely. I started mapping the vault drain data against the policy dates, and a pattern emerged that made the hair on the back of my neck stand up. October 2025. China's combined SHFE and SGE vaults held approximately 1,190 tons of silver. That was the starting point. By November 21st, just 51 days later, those same vaults held 519 tons. According to AU Bullion's analysis, 670,000 kilograms of silver disappeared in under 2 months. That is 21.55 million troy ounces. And here's the detail that stuck with me. On November 21st alone, another 15,819 kilograms were removed. And the price of silver on that day was falling, not rising, falling. In normal markets, when price drops, sellers appear and buyers retreat. You buy low, you sell high. That is the fundamental logic of markets. But someone was pulling more metal out on a down day. That is not speculative behavior. That is strategic accumulation by an entity operating on a completely different timeline than the rest of us. I want to show you a historical parallel that made this entire investigation click into place. Because patterns matter more than predictions. And this pattern has played out before. In 2005, China began stockpiling copper at a pace the world had never seen. Month after month, exchange vault inventories drained. Copper flowed out of visible storage and into Chinese hands. The price at the time was still manageable. Western analysts scratched their heads. Why is China buying so much copper? The economy was growing, sure, but this accumulation seemed excessive, almost irrational. The answer became obvious within 18 months. China was building strategic reserves ahead of the largest infrastructure build-out in human history. They were buying everything they could get at every price they could manage before their own demand made the metal unaffordable. They were front-running their own consumption. The copper price did not double, it tripled. And by the time the rest of the world figured out what China was doing, it was too late. The metal was gone, the reserves were built. And the new price reflected a world where China held the inventory and everyone else held IOUs. Now look at what is happening with silver in 2026, and tell me if the pattern does not look identical. Vault drawdowns accelerating across 3 continents. Export controls locking refined supply inside Chinese borders. Only 44 state-approved companies allowed to ship anything out. Retail investors blocked from competing through fund suspensions and trading halts. Paper prices suppressed through a combination of margin hikes in the West and fund lockouts in the East. The playbook is the same. But the stakes are higher, because in 2005, copper was not simultaneously being designated a critical mineral by the United States, discussed for international price floors by 55 nations, and about to be remonetized by the world's largest democracy. Silver has all of that, and the vaults are emptying faster than copper's ever did. Now let me give you the number that ties this entire investigation together. This is the part that made me sit back from my keyboard and just stare at the screen in silence. China's export controls went into effect January 1st, 2026, at the current SHFE drain rate of 42 tons per week, and with approximately 412 tons remaining in the vaults, the inventory approaches zero around mid-April 2026. I checked that math 3 times. Mid-April. Then I looked at something completely unrelated. India's Reserve Bank has issued new regulations allowing silver to be used as formal bank collateral, effective April 1st, 2026. This is the first remonetization of silver by a major economy since the 1800s. 1.4 billion people are about to gain access to silver as a recognized monetary asset. I looked at those 2 dates side by side. The week the Chinese vaults approach empty is the same week India goes live with silver as money. I did not manufacture that convergence. I did not cherry-pick dates to fit a narrative. I ran a drain rate forward on a calculator and checked a regulatory calendar, and they landed on the same week. April 2026. Chinese vaults approaching zero. Indian monetization going live. The world's factory running out of visible silver at the exact moment the world's largest democracy tells its population that silver is money again. When I saw that, I understood that this story is not just about inventory data or commodity trading. This is about a once-in-a-generation restructuring of who holds silver, in what form, and under whose rules. Now let me tell you what this means if you are invested in silver, because data without implication is just trivia. The paper price, that number you see on your screen, the number that made you sick when it crashed, that price is set by exchanges that are running out of the physical metal they need to back those prices. SHFE approaching zero. COMEX registered bleeding since September. LBMA free float at historic lows. When the physical runs out, the paper price stops being a market price and starts being a fiction. And fictions do not survive contact with a delivery notice. The question every silver investor should be asking right now is not where is the price going this week. It is what happens to price discovery when the vaults that underpin it are empty. That moment is not theoretical. It is 10 weeks away. And no one on mainstream financial television is even discussing it. If you are holding physical silver or quality mining stocks and you have been watching this crash, wondering if you made a mistake, I need you to understand something. Silver is not crashing because nobody wants it. Silver is crashing because someone wants all of it. And they need the price low enough to take it before the rules change. You are not wrong. You are early. The vaults prove it. The data confirms it, and history shows exactly what happens next. In the next video on finance currency, I am going to show you exactly what happens when those vaults approach zero and the paper market collides with physical reality. What I found will change how you think about the price on your screen. I will keep watching. I will keep tracking every vault report, every delivery notice, every policy change. And when those vaults hit empty, I will be here to show you what happens next. 10 weeks? The clock is running. This is finance currency. This is not financial advice. This is what the data shows. What you do with it is your decision. Hit subscribe so you do not miss what is coming. And I will see you in the next one.